Morning, this is Duane Lowry for the DPP Grain Desk. It is currently 5:50 on Wednesday morning, the day after the election. I thought we'd have a little update here. We've had some technical issues on the with YouTube videos the last 2 weeks, and so I thought I'd do a post-election comment here this morning. First of all, I think there are some realities left from the election and some post-election realities that we need to discuss that really aren't necessarily politics, but will become the outcome of politics. Maybe we'll put it that way. First of all, let's look at a backdrop here of where we're at. The grain market is, by virtually every standard of measurement, has been underperforming expectations for quite a long time. And since the 1st of October, there's been an earnest push to look for a seasonal low. I certainly was agreed with that type of expectation at different times here during the last several weeks. The market has stabilized. We've created some bottoms. We've had a rally, but overall the price action is still disappointing. We've been unable to build upon any type of seasonal bottom formation. We've been unable to build upside momentum. We've had many days where the market has underperformed expectations. In the case of the corn, just a couple of days ago, we had the lowest closing price we'd seen for several weeks. In the case of beans, just in the last day or two, we closed at the lowest level seen since mid-October. The only market that's performed well is wheat. There's probably a bullish fundamental storyline there, but in the same token, it's a storyline that we've seen before, and it's a storyline that has failed to develop any serious trending higher pattern. And I think a lot of the wheat strength we've had over the last couple weeks, a few weeks, whatever, has largely been an unwinding of intermarket spreads. It's been related to strength in wheat as they liquidate poor performing corn positions and bean positions, and then reverse and cover their previous short positions in wheat. I think that's more of a statement about why wheat has been strong as opposed to some new particular storyline of their own. Whatever bullish fundamental storyline you can put on wheat, you still look at global wheat carryout numbers. They're not troubling. You still look at U.S. soft red winter wheat acres expected to be, sharply higher this fall. So there's two sides to that coin. I'm not sure that there is a strong independent story in wheat fundamentally to drive prices into a trending higher pattern, especially when you're already trading, $8, almost $9 wheat. If anything, new crop wheat prices look like pretty attractive producer forward pricing opportunities, if you ask me. As far as corn is concerned, we have the bullish fundamental storyline that's been with us forever, and that is a small U.S. crop. That's certainly a fully known storyline, and price action in response to that storyline can be labeled as nothing but disappointing as far as I'm concerned in relationship to expectations. And when you add on that the fact that in the last several weeks we've had a lot of seasonal bottom picking take place in corn, a lot of belief that the low made at the end of September was the seasonal bottom, and a lot of length has been established in the market, and the markets have had to absorb an awful lot of buying energy during the last few weeks because of that. Yet here we are at the lowest closing prices just 2 days ago that we've had in over a month. That is not a good sign. It's a sign that the speculator is not here to really sponsor a big rally. There's not new money flowing in, and now we've got the election behind us. There's going to be some level of knee-jerk reaction that believes that, well, since Obama wins, that means continued loose money, monetary policies, continuous stimulus, things of this nature. Maybe there's a certain amount of truth to that and merit for that type of knee-jerk reaction, but the how long you maintain a loose monetary policy and whether there's stimulus spending is going to depend on a lot of factors other than the fact that he won re-election. If the economy continues to improve, even at a slow pace, the Fed's probably not going to do anything for new stimulus, but it's going to maintain low interest rates, for example. Getting any type of stimulus spending bill through Congress is going to still be extremely difficult. You still have a divided Congress, so I don't think you're looking at anything really new there. So I think there's going to be a certain amount of disappointment left in the post-election period for any type of new spending. So I don't think you have anything here that is going to trigger a large, confident influx of commodity investment from the speculative community, and it's especially difficult to do those kind of things when you've only got 6 or 7 weeks left in the calendar year. This is the time of year people are looking to take positions off, not looking to add to them. So that goes against that possible theory. The other problem you have in this post-election environment, investor and trader focus is going to very quickly shift to the fiscal cliff that's looming at the end of the year, that if we don't reach some sort of agreement, we're going to have automatic tax increases, and we're going to have automatic spending cuts. The combination of more tax revenue coming into government, less spending by the government, the impact on the economy, many economists fear would send us into a recession. Right or wrong, the marketplace is going to look at this fiscal cliff concern and see that as troubling. And I think people had thought and hoped that if Romney won and the Republicans were able to control at least the House, that would move more towards a quick solution to a fiscal cliff, not allow the Bush tax cuts to expire, and basically come to a compromise deal that would avoid that fiscal cliff. With Obama winning re-election, Democrats picking up additional leverage in the Senate, the House Republicans have got to make a decision here about how they're going to handle the president in the next term. Are they going to take the same approach they had in the last 2 years, or is it going to be more of a seeking common ground type of approach? The fiscal cliff here is going to be the first issue for that political landscape to determine how that's going to play out, and I think that the marketplace is going to fear that they're probably going to expect some sort of agreement to eventually be reached that avoids the fiscal cliff, at least most of the implications of the fiscal cliff. But I think that they're going to be afraid that we're going to have enough partisanship here that we're going to take this all the way to the edge, and we're going to take it right to the brink of the fiscal cliff. And I think that type of nervousness is not healthy for markets. There's also some people that felt that the recovery in the stock market over the last few days was in anticipation that there'd be a Romney win. Obviously that didn't happen. The overall trend, as we've talked about before, in the stock market looks troubling. The market has been trending lower. The last few days we've had some strength, but I'm not sure that there's much opportunity to build upon that. And I don't think the investor mood is very confident in building upon that, especially with this fiscal cliff ahead of us. So that spells some trouble and concern for the stock index. That also spells trouble and concern for the crude oil market, which has been breaking here over the last few weeks. Had some corrective here in the last couple of days, but it's just a correction move. The bigger move looks to be down. That is not bullish commodities in general. The U.S. dollar index has been strengthening for a few weeks. I think that's going to continue. Just to offer perspective, as I'm speaking and looking at the screen right now, this dollar index is 30 points off the low that occurred shortly before the election results were really visible. And I think that maybe even shortly after the results were visible, thinking that Obama's re-election would mean a loose monetary policy and a weak dollar. Well, it's here by morning, just hours later, that dollar index has recovered. It's back to near unchanged, and it looks poised to continue to trend higher like it started here over the last couple of weeks. I think this is the beginning of a bigger move in the dollar to the upside, a bigger move to the downside in a lot of commodities, and I think we've already seen it unfold in crude. We're seeing trouble ahead in the stock index. We're seeing the gold market suffer, which is basically a reflection of a stronger dollar, a reflection of less need for stimulus maybe, or less expectations for a weaker dollar, however you want to label that. None of this is positive commodities, and none of this encourages new buying and new speculative money into the commodity trade. With the grain market already vulnerable by underperforming expectations over the last few weeks, many longs established in wheat, many longs established in corn on hopes of a seasonal bottom, and the bean market that's not performing well. It's got very South American weather, large acreage increase expected down there. Without a South American weather problem, bean prices will be seen as too high. The other thing that's happening is you've got some global veg oil prices that have been weakening for a while, and you've got concerns about Chinese demand experiencing a lull in import demand for a while. And I think that all of that has created more of a two-sided atmosphere in beans than we've seen for some time, which means you've got people willing to trade from the short side. So when you throw all these things together, we've got a window ahead of us here that could be defined as, you know, maybe a few weeks, maybe into the end of the year, where markets could act heavy for reasons other than just grain-related reasons. So in this post-election environment, maybe we've got a day or two where the market tries to continue the recovery theme that we've had the last day or two. But I'm concerned the market quickly shifts focus and concern to this fiscal cliff, and I'm concerned that that exerts some pressure here on the grain trade as well. For the DPP Grain Desk, this has been Duane Lowry.